Hello and welcome back to Chapter 4 Notes. So in this Chapter 4 lecture video, I'm going to cover cost, volume, profit analysis. So I say right over here, once we've identified and estimated fixed and variable costs, we can do cost, volume, profit analysis, which is just another fancy word, in my opinion, for doing what-if analysis. So you can see right over here, it says, we say it examines the behavior of total revenues, total costs, and then changes in operating income as we might change the selling price, the variable cost per unit, or fixed costs. So we could say, what would be total revenues and total net operating income be if we sold another 1,000 units? Or what if we increased advertising, and by doing this, this increases sales, but it also increases our fixed costs? Will this give us more net operating income? Okay? Those are the kinds of questions that we would answer with cost, volume, profit analysis. Okay? So we say over here, one thing that can help us with cost, volume, profit analysis is to use the contribution income statement, which is also known as the variable costing income statement. Okay? And so this one breaks out costs differently than our traditional income statement that we use for financial reporting. You know, the one that we use for financial reporting, we have our sales less our cost of goods sold gives us our gross profit, less our operating costs would give us our net operating income. And then from there, from net operating income down to net income, so subtract out not operating losses, add back add not operating gains, and interest expense and taxes to get down to net income. But we're dealing only down to here with net operating income, because obviously if it affects net operating income, it's going to flow down to affect net income as well. Okay, so again, when we talk about the traditional way of separating out the income statement, we have our cost of goods sold, and then we have our operating expenses. Cost of goods sold are product costs. Operating expenses are a period cost. So we're separating out the costs in terms of the, not here, but in the traditional income statement between product and period. In the context of cost, volume, profit analysis, we would use our contribution income statement, which separates out our costs, our expenses, by variable and fixed expenses. So these are all variable expenses, regardless of whether they're product or period expenses. So this could include commissions and direct materials. These are fixed. Commissions would be variable period, and direct materials would be a variable product. With fixed expenses, again, we're grouping these over here based on cost behavior. They're all fixed expenses. They could be fixed product and fixed period. So it could be rent on the factory and also rent on corporate headquarters. Rent on corporate headquarters would be a period cost. Rent on the factory would be a product cost. We subtract those to get down to net income. Now our contribution margin is defined as sales minus variable expenses gives us contribution margin. Okay, that's all it is, and it's profit before you subtract out your fixed costs. That's what it is. Okay. You can also put this on a per unit basis, where you could say our sales price minus our variable expenses per unit would give us our contribution margin, or you can do it in terms of totals. Okay. Now, as I said over here, we can express, if this is our total income statement, we can express all these line items on a per unit basis, and that will help us with cost, volume, profit analysis. So if I sold 500 bikes, and let's just assume that I sell one type of bike, okay? Just sell one type of bike for a single price, just to keep things easier. And that's what we're dealing with is our bike shop. I sold 500 bikes for a total of $250,000. How much did I sell each bike for? Take my $250,000 divided by my 500 bikes, $500 per bike. Our variable expenses are $150,000, and that's for 500 bikes, which means our variable expenses per bike are $200. Then I can go through and calculate out my contribution margin. And again, I could just take 500 minus 300 to give me the 200, or I could take my 100,000 divided by my 500 bikes to also give me $200 per bike. I could put my fixed costs on a per unit basis and my net operating income on a per unit basis. It's not going to help us too much here, but I'll go ahead and do it. I just take the 80,000 divided by the 500, 160, which means I have $40 in net operating income per bike. Okay? Now, I'm going to talk about break even here, and we're going to talk about this again in a subsequent lecture video for Chapter 4, but I'm just going to go ahead and introduce the concept right over here. So we say break even is the level of production where our profit equals 0. So this number, profit, net operating income, will be 0. Okay? So basically, how many units do we have to sell, or how much do we have to have in sales dollars in order to have net operating income be 0? This is an important thing to know, because you want to know how much you have to sell in order to break even if you don't want to be an accountant. If you just want to have your own shop in downtown Fredericksburg, you need to know this. You need to know how much do I have to sell in order to break even. Okay? And basically what you're asking is, what you're really asking, how much contribution margin do I have to generate in order to cover my fixed expenses? Because if this number is 80,000, contribution margin is 80,000, that means net operating income is 0, because 80,000 minus 80,000 gives me 0. So really the question is, how much do I have to sell to get $80,000 worth of contribution margin? Okay? And that's what I'm saying over here. Right? How much does our RBC have to generate? How much contribution margin they have to generate? 80,000. Okay? So if we look at this diagram, we can see that up until we hit break even, we're running at a loss. And at break even, we have 0 profit. Any profit beyond the break even point is any contribution margin beyond the break even point becomes profit. Any contribution margin beyond the break even point becomes profit, and that's because if this is 80,000, 80,000 minus 80,000 is 0. At 80,000, I have enough contribution margin to cover my fixed costs. So any additional contribution margin flows down to net operating income. Okay? And that's what this diagram is showing you. So the question becomes, back to our question, how many bicycles then do we need to sell in order to cover our fixed costs and break even to get 0 profit? Well, I need to have $80,000 worth of contribution margin. Each bike gives me $200 worth of contribution margin. I can divide that by my 200, which means I need to sell 400 bikes. I sell 400 bikes, 400 times the 200 gives me 80,000. I sell 400 bikes, and each bike gives me $200 worth of contribution margin. I will generate $80,000 worth of contribution margin, and at that point, I will break even. Now, that's something you'd want to know, even if you didn't want to become an accountant. You just wanted to open your own little bike shop in downtown Fredericksburg. Okay? Continuing on looking at the next page, right over here, what if we said, let's look at a different question. What if RBC sold 430 bikes? What would the net operating income be? Now, there's a couple different ways that we could do this. We could do it the long way, which was we could come over here and say 430 bikes times 500, which would give us total sales of 430 bikes, minus 430 bikes times 300, which would give us our total variable expenses. Subtract the 2, that would give us our contribution margin, and then subtract $80,000 because $80,000 are our fixed expenses and they should not change, okay, would then give us our net operating income. Or what we can do is say, look back to what I was talking about earlier that said, what if any contribution margin beyond the break-even point becomes profit? So the break-even point, remember, was 400 bikes. So how many bikes are we beyond the break-even? 30. So what I could do is go 30 bikes times the $200 per bike gives me $6,000. And that would be my net operating income. Okay? And again, you could do it the long way by taking 430 times 500 minus 430 times 300. Subtract the 2, you get contribution margin. Subtract 80,000, and you will get $6,000. Okay? The one thing about this chapter that's nice is that if you run into any difficulties, remember the profit equation. Okay? So profit, what what basically I'm doing here is I'm showing you the profit equation a couple different ways, okay? So profit equals sales price times the number of units that you sold, minus your variable expenses per unit times the number of units that you sold, minus your total fixed costs. Sometimes, rather than expressing it as X, sometimes you'll see it as Q for quantity. And what I did is I factored out the X and called it Q, and I said sales price minus my variable costs times my quantity minus my fixed costs would give me profit, okay? Or, remember that this is contribution margin. So I can say contribution margin times Q minus my fixed cost equals profit. So if we think about that in terms of what we just did with our break-even, remember we said, what's profit at break-even? It's 0. 0 equals my 200 Q minus my 80,000. Therefore, 80,000 equals 200 Q, and then I could say my 80,000 divided by my 200 gives me 400, which equals Q. That's how many bikes I need to sell to break even. Okay? So you don't even have to memorize the break-even formula. So you just need to memorize, or you just need to understand the profit equation. Okay? And so we could also do this. We'd come over here to use that to solve this problem. You could say, well, remember, our contribution margin per unit is 200 times 430 bikes, right? We sold 430 bikes minus 80,000. And that's going to be extra 0 there. That'll be equal to our $6,000. That's the other way we could do this problem. Okay? Let's take a look at the contribution margin ratio. So our contribution margin ratio is defined as contribution margin as a percentage of total sales. Okay? So this basically, it says how much contribution margin do you get? How much contribution margin do you get for every dollar of sales? Okay? So when we look back over here, we can calculate this on a per unit basis, or we can calculate it in total. It will be the same because we're only dealing with one product. Doesn't always have to be. If you have multiple products, yeah, you would have different CM ratios. Okay. So in terms of the unit basis, we could come over here and we could take our 100,000 divided by our 250. Or on the unit basis, we could say our 200 divided by our 500. In any case, it equals 40.4. It says that we get 40 cents of contribution margin for every dollar of sales. Okay? So now what we can say is what would be the increase in contribution margin if we increase sales from 400 to 500 bikes. Okay? So we can use this contribution margin ratio to solve that problem. So if we looked over here, remember at how much would be total sales at 400 bikes, which is break even? Well, the number would be 200,000, right? Because we would have 400 bikes times $500 per bike would give us $200,000. What's our total sales at 500 bikes? It's $50,000. Okay? Pardon me, $250,000. So the difference in sales, right? The difference in sales, okay, in sales equals $50,000. As I move from 400 to 500 bikes, I have an extra $50,000 in sales. Okay? So what I can do is I can say, what is this point 4 telling me? It says that I get 40 cents of contribution margin for every dollar of sales. So if that's true, how much contribution margin do I get from an extra $50,000 of sales? I can go my 50,000 times my 4.4, which is going to give me $20,000. Okay? And that will also be the change in net operating income because I'm past the break-even point. Remember, if I have 400 bikes, this number is 0 because it's break-even. And then if I do 500 bikes, I get $20,000, which is also equal to the increase in contribution margin because I'm beyond the break-even point. Okay? I'm going to end this lecture video here, and we will continue with the next page on the next lecture video. Thank you.